Look, I think the framework for equities remains a very productive one. I think it's evidenced by the fact that share prices continue to move higher. And it's really interesting. I think, as we've discussed a lot during the past 12 months in these interviews, we go through different stages within a market cycle, and we have very much moved into the final stage now, which thankfully is the longer stage. So if I look back in history, it normally takes around sort of 5 years, but it's a very strong V-shaped recovery that we're seeing coming through in profitability for companies in New Zealand and Australia and around the world. And we'll run through some of the reasons as to why that is, but it's a very accommodative backdrop for us. And it's interesting when I think about what is going on in Australia, and you appreciate that when we invest money at Devon, we always think about New Zealand and Australia almost as one market that we can invest into, which is really quite exciting. They are enjoying this year around sort of 20+% growth in terms of earnings, and next year it'll still be very strong. And it's interesting when you think about profit cycles. It's always different, the sets of factors which influence the outcomes that companies are going through. And if I think back over the past 12 months, a lot of the impacts this time around have been one-off, again, as is often the case. So if we think about some of the key drivers of value in the Australian stock market, resource companies are substantially big. And so the iron ore price during the past 12 months has gone from $70 a tonne to $180 a tonne. And that's a large tailwind for a very important sector within the Australian market and the Australian economy as well. You've had a situation where the banks provided a lot early in the situation with COVID because it just looked like such an uncertain time. But as things have progressed and we've moved through it, there's been a realisation that they didn't need to be quite as conservatively positioned as what they were. So they've released a lot of that capital, and that's also been quite a big positive impulse for the outcomes for those banks. And again, a big part of the equity market. Housing's been strong across New Zealand and Australia, great for construction companies, and also it's such an important wealth effect across both countries and around the world, as we've seen that particular asset class move higher and higher due to low interest rates. As people just feel that wealth effect, they spend more money, and so again there is a ripple, sort of set of outcomes that come from it. And I guess what we've moved into now is the final stage, which is really just this progress towards normalisation, as a consequence of the COVID vaccines. And I think this is going to take some time to play out, which again, is really important. It's very much driving the economic outcomes we're getting, and it really will underwrite, a continuation of the earnings growth coming through that we have. When I think about this stage in the markets, it really is. It'll be a period that we don't see the same level of sort of upside risk in terms of share prices, but we will continue to migrate higher. And when I look back through history at situations where which have catalysed an end to the cycle, you do occasionally get the exogenous effects, such as the oil embargo from OPEC back in the 1970s. But typically it really comes on the back of central banks and governments putting a halt on things prematurely. And when I think about the US Federal Reserve, which is really the benchmark central bank for financial markets globally, they have created a very new policy framework of response, if you like, to their inflation targets. And they have conceded they will be very slow in terms of addressing any sort of spikes that they see in terms of inflation. They're essentially taking a passive approach to it. And inflation is one of these things which comes up often when I'm having these conversations around one of the key risks that we might face over the next 12 to 24 months. And I do think that a lot of you will have had and will have quite almost explicit examples anecdotally of where you're seeing supply chains under real pressure, whether or not you're buying a new car or buying furniture. Everything's taking a long time, and we will see pricing pressure come through as a consequence of that. But when I look globally, there's still a lot of slack left in the global jobs market, and as a consequence of that will certainly offset, I think, to a reasonable degree where we get to. So, but no, all of that taken into consideration, I do think we are still in an environment where interest rates at the long end of the curve are likely to continue migrating higher. I don't think it will move sufficiently high that we'll see a major retracement back in share prices, but it is something that as investors we do need to keep an eye on.